Welcome back to the deep dive. Today, we're taking one of those really core financial reporting standards, International Accounting Standard 36, Impairment of Assets, and we're going to break it down. Our mission here isn't just to talk about it, but to give you a really clear, exam-focused roadmap. We want you to know exactly what impairment means, how you test for it, how you calculate it, and, crucially, how you present it to get those marks in your FR exam.
Absolutely. And IAS 36 is fundamental, really. It ties straight back to the conceptual framework. We're talking about principles like prudence and faithful representation. I mean, if an asset's carrying value on your balance sheet is way higher than what you can actually get back from it, then, well, your financial statements are misleading, aren't they?
Right. That prudence idea being cautious, not overstating things. So if the books say an asset is worth $100,000, but realistically, the best you can get from using or selling it is, say, $80,000, the $100,000 number just isn't true anymore.
Exactly. It's not faithfully represented. The company's essentially overstating its resources. So the moment the recoverable value dips below the carrying value, the book value, you have to recognize that difference. It's an impairment loss.
Okay, so that's the core definition we need to lock down right at the start. Impairment happens when the carrying value, the CV, is more than its recoverable amount.
That's the bedrock. And for the exam, nailing this means mastering 3 key steps. First, you've got to spot the signs, the indicators that tell you if you even need to do a test. Second, you need to calculate that recoverable amount accurately. That's often the calculation-heavy part. And third, you have to know how to record the loss properly, especially, when you've got complications like cash-generating units or maybe previous revaluations muddying the waters.
Okay, let's unpack that first step then. Identifying the indicators. It sounds like a huge job to test every single asset for impairment every single year. Why don't companies just do that to be safe?
Yeah, good question. It comes down to practicality and cost versus benefit.
Yeah.
Testing everything constantly would just be, well, massively inefficient. Think of the management time, the forecasts involved. So IAS 36 says, look, you only need to perform the detail test if there's some sign, some indication that the carrying amount might not be recoverable.
But you mentioned exceptions earlier. Some assets do need checking every year.
Yes, that's crucial. 2 main categories always require an annual impairment test, regardless of indicators. First is goodwill that you acquired in a business combination. And second is any intangible asset with an indefinite useful life. Think maybe certain brand names or licenses that don't get amortized. Because their value isn't systematically reduced through depreciation or amortization, and it can be quite sensitive, they need that annual checkup.
Got it. Goodwill and indefinite life intangibles annual test mandatory. But for everything else, your regular property, plant, equipment, we need a trigger. And the standard splits these triggers.
Into external and internal sources. And this split is really helpful when you're reading an exam question. You should be actively looking at the scenario details and thinking, okay, is that an external factor or is it something internal to the company?
All right, let's tackle external first. What's happening outside the company that might signal an impairment?
Okay, the most obvious one is a significant decline in the asset's market value. And the standard stress is significant. We're not talking about the usual wear and tear depreciation. This is a bigger, more unexpected drop. Maybe technology has moved on, making your asset less desirable, even if it still works fine. The market just doesn't value it as highly anymore.
Like if a much better, cheaper version comes out.
Exactly. Or perhaps there's been a significant adverse change in the environment the company operates in. This could be technological, like you said, or it could be economic. Maybe a massive recession hits your market. Or it could be legal. Imagine a new environmental law gets passed that bans a process your main factory uses. Suddenly, the value of that factory could plummet.
So external shocks, market value, technology, economy, laws. What else?
There's also an interesting one related to finance costs. An increase in market interest rates or other market rates of return. This matters because those rates feed into the discount rate used to calculate the value in use, which is one part of the recoverable amount. Higher discount rates mean lower present values, which could push the recoverable amount below the carrying value, even if the expected cash flows haven't changed.
Okay, that's a bit more subtle. It affects the calculation side. Now, what about internal indicators? What signs within the business suggest an asset might be impaired?
Internally, you're looking more at the asset's condition and how it's being used. So clear things first. Obsolescence or physical damage. If a machine breaks down badly or is clearly outdated, that's an indicator.
Makes sense. Physical deterioration.
But it's not just about physical damage. It's also about changes in use. Have there been significant changes in the extent or manner in which the asset is used or expected to be used? Maybe the company has decided to idle the asset, or there are plans to dispose of it earlier than originally planned. Or perhaps there's a major restructuring going on, and this asset's role is changing or diminishing. All these point towards getting less economic benefit from it than planned.
So strategic decisions impacting the asset's future use.
Precisely, and that often links to the next internal indicator. Evidence that the asset's economic performance is or will be worse than expected.
Mhm.
Are there internal reports showing this asset or the unit it belongs to is consistently making losses or generating much lower cash inflows than budgeted? If it's costing more to run than it brings in, that's a big red flag for impairment.
And you mentioned one earlier that sounded quite specific, losing a key person.
Ah, yes, that's a fascinating one under internal sources,
Mhm.
evidence from internal reporting. Imagine you have a highly specialized piece of equipment, and only one engineer in the company knows how to operate it effectively to generate maximum output.
Mhm.
If that engineer leaves, the physical asset is unchanged, but its ability to generate future economic benefits for the company might be severely curtailed. The value isn't just in the metal, it's in the whole system, including the people needed to make it work. It shows value is broader than just the physical thing.
That's a really good illustration. Okay, so step one for our listeners in the exam. Read the scenario carefully, pull out those facts, the market crash, the new law, the machine damage, the restructuring plan, the key person leaving, and map them to these specific IAS 36 indicators. That's the justification for doing the test.
Exactly. Identifying the trigger correctly is the first hurdle cleared.
Right, hurdle cleared. Now we have an indicator, so we must perform the impairment test. This means calculating the asset's recoverable amount. This feels like where the numbers really come into play.
It certainly is. This is often where students need to be most careful with calculations. The recoverable amount is defined very precisely. It's the higher of two specific values.
Higher of.
The higher of the asset's fair value, less costs to sell, FVLCTS, and its value in use, VIU.
Okay, why the higher? Why not the lower to be more prudent?
Because the standard aims to reflect the economic reality of what the company can recover. If you could sell the asset today for, say, $50,000 after costs, but keeping it and using it would only generate future benefits worth $40,000 in today's money, well, the rational economic decision is to sell it. You can recover $50,000. So the recoverable amount reflects the best outcome available to the entity. It's the maximum economic benefit.
Got it. Higher of the two, because that's what the company can realistically get back. Let's break down those two components. Fair value, less costs to sell FVLCTS. That sounds fairly straightforward.
Generally, yes. It's based on market information, if available. Fair value is usually the price in an orderly transaction between market participants. Think observable market price, recent transactions for similar assets. And then you subtract the direct costs of actually selling it. Things like legal fees, stamp duty, costs of removing the asset, maybe commissions. Importantly, these are costs the seller incurs, not costs the buyer might incur.
Okay, so market price minus selling costs. That's option one, sell it. Now, option two, keep using it. This is value in use, VIU. This sounds like the more complex one, involving forecasts.
It definitely is. VIU is all about the future. It's the present value of the future cash flows expected to be derived from the asset's continuing use and also from its ultimate disposal at the end of its life. This means estimating future cash inflows, future cash outflows related to using the asset, and then discounting them all back to today's value using an appropriate discount rate.
Right, the discounting. Present value calculations. What are the key things to watch out for here? The common pitfalls.
Oh, there are several. A huge one, often missed, is the tax treatment. IAS 36 requires that the future cash flow projections must be on a pre-tax basis. And consistently, the discount rate you use must also be a pre-tax rate that reflects the time value of money and the specific risks of the asset. You cannot mix pre-tax cash flows with a post-tax discount rate, or vice versa. Examiners look for this consistency. Many people slip up and use the company's overall post-tax WACC, which is wrong here.
Pre-tax cash flows, pre-tax discount rate, that's a critical exam technique point. What else needs to be excluded from those cash flow forecasts?
You have to be careful what cash flows you include. Definitely exclude cash flows related to financing activities. So no interest payments or loan repayments related to how the asset was funded. That's separate. Also exclude income tax receipts or payments. We handle tax separately, hence the pre-tax approach. And another big one, you exclude cash flows expected from future restructuring that the entity isn't yet committed to, or from improving or enhancing the asset's performance beyond its current condition. The VIU reflects the asset as it is now, not after some hypothetical future upgrade.
So no wishful thinking about future improvements, just the asset in its current state. And how far into the future do these forecasts go? Can management just project profits forever?
No, the standard puts a practical cap on detailed projections. Typically, cash flow projections should cover a maximum period of 5 years, unless you can strongly justify a longer period. Beyond that 5-year detailed forecast, if you need to capture longer-term value, you'd usually extrapolate using a steady or declining growth rate. Often, zero growth is assumed for simplicity to calculate a terminal value. But the detailed bid is usually capped at 5 years to limit speculation.
Okay, 5-year horizon usually. Let's make this concrete. Can we walk through a simplified VIU calculation focusing on the discounting?
Sure. Let's say we have an asset with a carrying value of $25,000. We've identified an impairment indicator. FVLCTS is, let's say, $24,000. Now for VIU. Management forecasts the following net pre-tax cash flows from using the asset over the next 5 years, including a tiny disposal value in year 5. Year 1, $5,000. Year 2, $6,000. Year 3, $5,500. Year 4, $4,500. Year 5, $4,000, including disposal. And the appropriate pre-tax discount rate is determined to be 10%.
Okay, so we need the present value of each of those flows at 10%.
Exactly. We need the discount factors, 1.1, and so on. So year 1, $5,000, $1.10, 1.2, $4,945. Year 2, $6,000, $1.10, which is 1.21, equal 4,950 cents. Year 3, $5,500, $1.3, which is 1.464, equals $3,774. Year 5, $4,000, $1.05, which is $1.61 with $2,483.
Right, so we sum those individual present values.
Adding those up, $4,545 plus $4,952 plus $4,132 plus $3,783 plus $2,483 gives us a total value in use, VIU.
$19,193.
Okay, VIU is $19,193, and we said FELCTS was $24,000.
And the final step in this stage, compare recoverable amount to carrying value. CV is $25,000.
CV $25,000 is greater than recoverable amount, $24,000. Therefore, we have an impairment loss of $25,000, $24,000, $1,000.
Perfect. That step-by-step process, calculate FVLCTS, calculate VIU carefully using present values, pick the higher number, compare to CV that nails the measurement step.
Precisely. Showing that methodical approach gets the marks.
Okay. Indicator identified, recoverable amount calculated, loss confirmed. Step 3, recording the loss. Let's start simple. If this is just a regular asset carried under the cost model in IAS 16, where does that $1,000 loss go?
Straightforward case. The impairment loss is recognized immediately in profit or loss, PL. The accounting entry would essentially be debit impairment loss, PL expense, $1,000, and credit the asset's carrying amount, $1,000, to reduce it on the statement of financial position.
Simple enough, debit PL, credit asset, but accounting is rarely that simple, is it? What's the big complication here, the interaction with IAS 16's revaluation model?
Exactly. This is a classic exam trap,
Yeah.
and where you can really show higher level understanding. If the asset that's impaired has been previously revalued upwards under IAS 16, and there's still a balance sitting in the revaluation surplus in equity relating to that specific asset, you cannot just charge the whole impairment loss to PL.
Ah, so that previous upward revaluation, which went to other comprehensive income, OCI, and created the surplus, acts like a buffer.
That's a great way to think of it, a buffer. The rule is, the impairment loss is first treated as reversing that previous revaluation gain. So you reduce the revaluation surplus balance first via OCI, debit OCI, revaluation surplus, credit asset.
So the loss hits OCI before it touches PL.
Yes, up to the amount of the available surplus for that asset.
Yeah.
Only if the impairment loss is bigger than the existing revaluation surplus balance does the excess amount get charged as an expense to profit or loss. It prevents companies from booking unrealized gains in OCI and then booking the subsequent related losses entirely in PL. It ensures symmetry.
Okay, let's use that building example we touched on earlier to trace the entries. Carrying value, $975,000. Recoverable amount, $600,000. So total impairment loss is $375,000. And crucially, we look at equity and find there's a revaluation surplus balance specifically for this building of $325,000 from a prior upward revaluation.
Right, so we apply the rule. The first $325,000 of that $375,000 loss must offset the surplus. The entry, debit revaluation surplus via OCI in the statement of comprehensive income, reducing the equity balance, $325,000, and credit the building's carrying amount, $325,000. That wipes out the surplus for this asset. It's now zero.
Okay, surplus gone, but we still have more loss to account for. $375,000 total loss minus the $325,000 absorbed by OCI leaves. $50,000.
Exactly. That remaining $50,000 now has nowhere else to go but profit or loss. The OCI buffer is used up. So the second entry is debit impairment loss and expense in PL, $50,000. And credit the building's carrying amount, another $50,000.
So the total reduction in the building's carrying amount is $325,000 plus $50,000, $375,000, bringing it down to the $600,000 recoverable amount, which is correct, but the impact is split. $325K hits OCI, $50K hits PL. Understanding that split and why it happens is key.
Absolutely. Explaining why you're debiting OCI first, referencing the reversal of the previous gain, that's what differentiates a top answer.
Brilliant. Okay, that handles individual assets, including the revaluation complexity, but often assets don't generate cash flows on their own, do they? Like one machine in a huge production line, you can't really determine its individual VIU or FVLCTS easily.
Precisely. And that's where the standard introduces the concept of the cash generating unit, or CGU. This is probably the most complex part of IAS 36 application for many students.
So what exactly is a CGU? Can you give us the definition again?
Sure. A CGU is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or groups of assets. Think of it like a mini business within the larger company, maybe a specific retail store branch, a particular product line's factory, or a distinct geographical operation. It's the lowest level at which you can meaningfully assess largely independent cash generation.
Okay, smallest group generating independent cash flows. So if we have an indicator suggesting one asset within that group might be impaired, we can't just test that one asset in isolation, and we have to test the whole CGU.
That's generally the approach, yes. You determine the recoverable amount for the CGU as a whole, comparing the total carrying value of all assets in the unit to the CGU's overall recoverable amount, which would be the higher of the CGU's FVLCTS and its VIU. If the total CV of the CGU exceeds its recoverable amount, you have an impairment loss for the entire unit.
And then the challenge is allocating that total CGU loss back down to the individual assets within the unit.
Exactly.
Yeah.
And IAS 36 provides a very specific mandatory order for this allocation. It's a hierarchy. You can't just spread it evenly. This is the three-step allocation hierarchy, and it's critical for exams.
Right, let's break down that hierarchy. Step 1.
Step 1. Deal with any specifically impaired assets first. If there's an asset within the CGU that is obviously damaged or obsolete, and you can determine its individual recoverable amount, you write that specific asset down to its recoverable amount first. Any loss relating purely to that damaged asset is recognized before you start allocating the general CGU loss.
Okay, so isolate and write down any clearly damaged individual assets first.
Got it.
Step 2.
Step 2. Allocate the loss to goodwill. If there is any goodwill that has been allocated to this specific CGU from a past acquisition, the impairment loss must next be allocated to reduce the carrying amount of that goodwill. You keep allocating the loss to goodwill until either the loss is fully allocated or the goodwill balance is reduced to zero. Goodwill often gets wiped out completely because it has no independent value.
Goodwill takes the hit next, potentially down to zero. Makes sense as it's the most intangible part. What's step 3, if there's still loss left after hitting goodwill?
Step 3. Allocate the remaining loss to the other assets. Any remaining amount of the impairment loss is then allocated to the other non-current assets within the CGU on a pro rata basis, based on their carrying amounts after any step 1 adjustments.
Pro rata based on carrying amounts. Okay, seems logical. But you mentioned exam traps here earlier. What assets are excluded from this pro rata allocation in step 3?
Crucially important. You exclude current assets, like inventory, receivables, and cash, from this pro rata allocation. They are usually already measured at or close to their recoverable amounts under other standards, like NRV for inventory. The impairment allocation focuses on the non-current assets like property, plant, equipment, and identifiable intangibles.
Right. Exclude current assets. Don't spread the loss onto receivables or cash. What was the other trap? Something about a floor.
Yes, the floor rule. When you're doing that pro rata allocation in step 3, you cannot reduce the carrying amount of any individual asset below the highest of A, its fair value, less cost to sell if you can measure it, B, its value in use, if you can determine it individually, and C, 0. Obviously, you can't make an asset negative. So if the pro rata allocation tells you to reduce a building's value by $100, but doing so would take it below its known market selling price, you only reduce it to that selling price. The excess loss that couldn't be allocated to the building then has to be reallocated pro rata amongst the other qualifying assets in the CGU.
Wow, okay. That adds another layer of complexity. You allocate pro rata, but you have to check you're not pushing any single asset's value too low below its own individual recoverable amount or FVLCTS. Let's try and apply this hierarchy. Can we use the structure of that Sharon Peter CGU example to walk through the numbers?
Let's do that. Imagine the Sharon CGU has these assets with their carrying values before impairment. Buildings, $7,000. Plant, $4 million. Goodwill, allocated to the CGU, $2 million. Other intangibles, a license, $1 million. Receivables, $500,000. Cash, $500,000.
Okay, adding those up, 7 plus 4 plus 2 plus 1 plus 0.5 plus 0.5, that's a total carrying value, CV, of $15,000 for the CGU.
Correct. Now, an impairment review is triggered. Management calculates the recoverable amount for the entire CGU as $11,500,000.
Right. So the total impairment loss for the CGU is CV, $15, minus recoverable amount, 11.5 meters, which equals $3,500,000. That's the total loss we need to allocate using the hierarchy.
Exactly. Now, step by step. Step 1, specific impairment. Let's say the review revealed that some specific items of plant within the CGU were damaged beyond repair, and their individual recoverable amount, basically scrap value, FELCTS, is effectively zero. The carrying amount of this specific damaged plant was $1 million. So we must first allocate $1 million of the loss directly to the plant, loss remaining to allocate. $3,500,000, $100,000, plant suggested CV. $4 million, $1 million, $3 million.
Okay, $1 million loss dealt with against the specific plan, $2 or $5 million loss left. Now, step 2.
Step 2, goodwill. The CDU has $2 million of allocated goodwill. We have $2,500,000 of loss still to allocate. We must allocate as much as possible to goodwill first. So we allocate the full $2 million to goodwill, reducing its carrying amount to zero. Goodwill CV is now $2 million, $2 million, $0 loss remaining to allocate. $2,500,000, $2 million, $500,000.
Right. Goodwill is completely wiped out, and we still have $500,000 of the impairment loss left to allocate. So now we move to step 3.
Step 3, pro rata allocation. We need to allocate this remaining $500,000, kerfroth the other non-current assets in the CGU based on their current carrying amounts.
Right.
Which assets are left in the pool for this allocation?
Okay, let's see. We have buildings at $7 million plant, which is now at $3 billion after the step 1 adjustment, and the other intangibles license at $1 million. We definitely exclude receivables, $500K, and cash, $500K. Goodwill is already zero.
Perfect. So the assets in the pro rata pool are buildings, $7, plant, $3 million, and intangibles, $1. The total carrying value for the pro rata base is $7 million plus $3 million plus $1 million, $11 million.
And we need to allocate the remaining $500,000 loss over this $11 million base. So the allocation proportion is $500,000, $11 million. What does that work out as?
Okay.
About 4.545.
Yeah, it's called roughly 4.545%. Now we apply this percentage to each asset's carrying amount in the pool. Loss allocated to buildings, $7 million x 500K 11 meters, 318,182 powers, approx. Loss allocated to plant, $3 million x 500K 11 meters, $136,364, approx. Loss allocated to other intangibles, $1 million x 500K 11 meters, in place $45,454, approx.
And if we add those up, 318,182 plus 136,364 plus 45,454. Yes, that comes back exactly to the $500,000 remaining loss. Phew.
And this is where you'd also quickly apply that floor rule check we mentioned. You just need to ensure that reducing the buildings by 318K, plant by 136Ks, and intangibles by 45K doesn't take any of them below their individual recoverable amounts, or FELCTS, if known. Assuming they're all well above those floors, these are our final allocations.
That structured, sequential allocation specific, goodwill, pro rata excluding current assets, checking the floor is absolutely vital to get right in an exam.
It really is. It looks complex, but following the steps methodically is the way through it.
Okay, we've covered identifying indicators, measuring the recoverable amount, and recognizing the loss for both individual assets and CGUs, including those tricky allocation rules. Is there anything else major under IAS 36? What about reversals? Can you ever write the value back up if things improve?
Yes, absolutely. IAS 36 does allow for the reversal of impairment losses recognized in prior periods, except for goodwill impairment, which can never be reversed. If the circumstances that led to the impairment have clearly improved, maybe the market bounced back, the damaged asset got fully repaired, the adverse regulation was lifted, then you need to assess if the recoverable amount has increased.
So good news potentially, but I sense there's a but coming. Is there a limit on how much you can reverse?
There's a very important limit, yes. It's often called the ceiling rule. You can reverse the impairment loss, but the increased carrying amount of the asset after the reversal cannot exceed the carrying amount that would have been determined, net of depreciation or amortization, had no impairment loss ever been recognized in the first place.
Ah, okay. So you can't use a reversal to sneakily revalue the asset higher than its original depreciated cost path. You have to calculate a what-if number. What would the carrying value be today if we just kept depreciating it normally without any impairment hit? And that number is the absolute maximum you can write the asset back up to.
Precisely. Let's say an asset was impaired down to $15,000 a few years ago. You calculate that if it had never been impaired, its normal depreciation schedule would mean its carrying value today should be $18,000. Now, conditions improve, and you calculate its new recoverable amount is actually $22,000. You can only reverse the impairment loss by $3,000, from 15K up to the 18K ceiling. You cannot write it up to the full 22K recoverable amount. That extra 4-tie increase above the depreciated historical cost is effectively ignored for impairment reversal purposes.
Got it. The reversal fills the gap back up to the would-have-been depreciated cost, but no further. That preserves the historical cost principle in a way.
It does. It stops impairment reversals becoming a backdoor revaluation method. Now, how do we account for the reversal? Where does the gain go?
Okay, so if the original impairment loss went straight to profit or loss, the symbol case, cost model asset, does the reversal just go back to PL as income?
Yes, generally. For an asset carried under the cost model, the reversal of an impairment loss is recognized immediately in profit or loss as income. Debit asset, credit impairment reversal gain.
PL. But I'm guessing the revaluation model complicates things again. What if the original loss was partly absorbed by the revaluation surplus in OCI?
You guessed it. The mirror principle applies. If the original impairment loss was charged against the revaluation surplus, OCI, for that asset, then any subsequent reversal of that loss must first be credited back to other comprehensive income, OCI, reinstating the revaluation surplus. You effectively refill the surplus first up to the amount that was originally taken out of it due to the impairment.
So you reverse the OCI hit first?
Yes. And only if the total reversal amount is greater than the amount needed to restore the OCI component does the excess amount of the reversal get recognized as income in profit or loss.
Let's quickly revisit our building. Original loss, $375K. $325K went against revaluation surplus, OCI. $50 went to PL. Now, let's say things dramatically improve, the recoverable amount shoots up, and we can justify reversing the entire $375,000 loss, assuming the ceiling rule allows it. How is that $375K reversal recorded?
Okay, first we reverse the OCI portion. We credit OCI revaluation surplus with $325,000. The debit increases the building's carrying amount by $325,000. That restores the surplus. Now we look at the PL portion. The original loss hitting PL was $50,000. The remaining part of our reversal is $375,000. $325,000, $50,000. So that $50,000 is credited to profit or loss as an impairment reversal gain. The corresponding debit increases the building's carrying amount by another $50,000.
Perfect symmetry again. The reversal mirrors the initial loss allocation between OCI and PL. Understanding that two-way interaction between IAS 17 revaluations and IAS 36 impairments reversals is absolutely top-level stuff.
It really is.
Yeah.
Being able to explain why part of the reversal goes to OCI and part to PL, linking it back to how the original loss was treated, that shows deep understanding. And remember, impairment losses on goodwill can never be reversed. Once it's gone, it's gone.
Right. Goodwill impairment is a one-way street. No reversals allowed. This has been incredibly thorough. We've really dug into the mechanics of IAS 36. Let's try and pull together the absolute must-know points for listeners aiming for exam success. Quick recap.
Okay, key takeaways. Number one, impairment testing isn't automatic for most assets. You need indicators external, market value drops, adverse environmental changes, interest rate hikes, or internal damage, obsolescence, underperformance, changes in use. But always test goodwill and indefinite life intangibles annually.
2, if triggered, calculate the recoverable amount. That's the higher of fair value less cost to sell, market price minus selling costs, and value in use. Present value of future pre-tax cash flows using a pre-tax discount rate, excluding financing tax future improvement costs, usually over 5 years max.
3, if carrying value recoverable amount, recognize the loss. For cost model assets, it goes straight to PL. For revalued assets, IAS 16, the loss first reduces any existing revaluation surplus, OCI, for that asset, and only the excess hits PL.
4, for cash-generating units, CGUs, the smallest group generating independent cash flows, calculate the CGU's total loss and allocate it using the strict hierarchy. Step 1, specifically impaired assets. Step 2, goodwill, down to 0. Step 3, remaining assets pro rata based on CV, but exclude current assets like cash receivables and obey the floor rule.
And finally, 5, reversals are possible, except for goodwill, if indicators reverse. The reversal goes to PL generally. BT, if the original loss hit OCI, revaluation surplus, the reversal must first replenish OCI before any excess goes to PL. And crucially, the reversal is capped by the ceiling rule. The asset cannot exceed the carrying amount it would have had with normal depreciation if no impairment had ever occurred.
Fantastic summary. IAS 36 is definitely challenging. There's a lot of interconnected logic, especially with the CGU allocations and the IAS 16 links. But breaking it down into those sequential steps makes it manageable and hopefully much clearer for exam purposes.
We really hope this deep dive helps you nail IAS 36 in your FR exam. Remember, practice applying these steps to scenario questions is key. Don't just learn the rules, apply them. We've put some extra notes and details in the description below this recording to help reinforce these points.
And remember, this deep dive is just one part of our ongoing SmartPass series covering IFRS and financial reporting topics. We'll be tackling more standards in future sessions.
So do check out those resources in the description.
And make sure you subscribe to the SmartPass YouTube channel so you don't miss out on future deep dives and expert guidance designed to boost your exam performance. Thanks for joining us today.
Keep working hard, and good luck with your studies.